In this week's update, has the easy money been made? The Fed gives certainty to markets over rates that the worst is done. Too many are still stuck on the headlines, and tracking the money flows wins again. My name's Gary Davis. As always, this is general advice, and please remember to like and subscribe to the video. I just want to start with some headlines that I saw last week, and these all occurred on the same day. And it really raises the question for most investors, how the heck are we supposed to know which one of these is correct? And I'll just run through them quickly. So the first one was, despite appearances, the ASX is close to as expensive as ever. That's a pretty negative headline. The second one is, the ASX looks like a bargain hunter's paradise. That's pretty positive. And the third one is, the worst is behind us, 9 stocks with plenty of upside ahead. So they all occurred on the same day, and if you're reading widely, then you're entitled to be pretty confused about what the outlook is. And these all reflect the biases of the authors. And because I do read quite widely, both bullish and bearish, it's very obvious that most authors have a particular heavy bias, either to the negative side. They always find the negative in a situation, and others have a more positive outlook. And that's just the reality, I guess, of the media. And this is so typical of the last few months, where the news flow really has continued to get worse, if anything, and yet seemingly the market has formed a low in the middle of June and has turned up. And back in March, I think there might be a link below this video today, but back on March 5, in that weekend update, I went through an exercise and showed you the headlines where the media just gets it consistently wrong over the years. And yet the media is still pretty influential because, you know, when we go through periods like we've just been through this year, we're all hypersensitive to to the news, and we're looking for some sort of explanation of what's going on. But just try and remember that that the media consistently gets it wrong at the turning points. So what is the effective way? If you can't rely on what business commentators are or fund managers are saying, what is the effective way to proceed? And as I've been doing for years and years and years, and preaching in this weekend video, the answer is to observe broadly. So don't just seize on one indicator or two indicators, because I think that's actually worse than not doing anything at all, because it can lead you to form the wrong conclusion. So observe very broadly, not only the stock market, but in other markets that are related, in the bond market and in the options market, which is what I do. And then, as much as you can, try and respond to that without bias. Now, we all have our inherent biases. Mine's typically bullish. That's just the way that I'm wired. And I understand that other people are wired a bit differently, but we've all just got to try and put that aside and look at the results and look at the evidence in front of us dispassionately. Now, I've never been comfortable highlighting the correct calls that I've made. It's just not my style. It's not the purpose of this video. And, I'm sure you've all heard the expression, rooster today, feather duster tomorrow. And that's always potentially the case in the market. And I've had decades of hard knocks that certainly hammers in a certain level of humility. So I never get terribly excited when things go right, because I know that something can go wrong just around the corner. But look, on this rare occasion, I'm going to touch on things that I've pointed out over the last 8 months, because I think it's a really valuable learning point that everyone can benefit from. And I'm still getting a lot of questions from people who are still very nervous. They don't believe that this rally is sustainable and that the bear market is going to revisit. So I think it's really important to reinforce what I've been saying all year. The first point is that you've just got to take a weight of evidence approach. You can't look at just one index, the S&P index, and say, oh, there's a bear flag, therefore this is going to happen. I mean, it's just worse than not doing it at all, because it just plants a negative seed in your mind and you can't see anything else. So you've got to use a very broad weight of evidence approach, and you've got to be able to get those calls right at the major turning points most of the time. And as I'll show you in a minute, I've made a number of observations about what the market is doing. It wasn't my opinion, it was just observation of the evidence that was in front of us. In January, I was extremely cautious on the market. In March, there was a 3-week rally which I acknowledged, said I didn't like it, it was too soon. There were a number of aspects of it that I didn't like. The market hadn't got bearish enough. So I acknowledged the rally in March, but I really didn't like it. I made another acknowledgement of the rally in May, and I felt that one was on better footing. Now, that turned out to be premature. But I then made another call in June, or another observation, I should say, because a call is really sort of saying you're making a prediction, which is something that I don't do. In June, I observed the weight of evidence in front of me, and it was, pretty compelling. So the issue with doing this, though, is that you're going to be in the absolute minority. So you better have an open mind, and you better have a lot of conviction around what you're doing, because the crowd's going to be against you, and it's not easy to to hold those opinions when everybody else is thinking something different. And we all know intuitively that sayings like buying when there's blood in the street is the best opportunity, or the famous Warren Buffett one, be greedy when others are fearful. We sort of know intuitively that they're truisms, but when the chips are really down, and our emotions and biases take over, then most people manage to get the timing of these major turning points completely wrong. So this is what members pay me to get right most of the time, and then make sure that we're focused on the effective sectors and stock allocations. So again, the whole purpose of me going through this morning is to reinforce this extremely valuable point that you've got to look more widely and not just seize on one or two indicators that fit your view of the world. So just to run through them very quickly, and this is all a matter of record. You'll find these in the prior videos on YouTube. On December 5 last year, these are the comments that I made along with that evidence. I said there was a rapid change of where the money is going. The money was starting to flow from the aggressive sectors and starting to flow quite obviously into the more defensive sectors. I said there was a huge weight of evidence pointing to the downside. This is December 5 last year. And that small caps were in for a tough time, because that is typically where the most damage gets done in a bear market. Then on January 9 and on January 16, I said there was a big multiple contraction coming, and there was a dramatic fall in growth versus value. Now, this wasn't a prediction. It was just a straight out observation of what was staring us in the face. It's just most people were still in party mode, and so their psychology didn't allow them to see what was on the page in front of them. On May 29, I said if this isn't the bottom, it's coming in a few weeks, and the market bottomed at the index level on the 16th of June, roughly 3 weeks later. I also said that I was seeing examples of stock behaviour that doesn't typically occur in bear markets. So again, it's just observation. Get your biases out of the way. And on June 26, I said it may be the bottom is in place, and the overwhelming weight of probabilities would certainly support that, and that cautious investors may wish to wait for more confirmation, which we got a couple of weeks later. So that's the history of what's happened this year. And if only you can get yourself away from the media and get yourself away from your natural biases and just look at the weight of evidence, then I think you've made a dramatic step forward in terms of being a better investor. I started making buy recommendations to the membership in the US and locally on the 6th of July. And, they've been going along quite nicely since then. If you're a serious investor, I'll come back to that. The market reality. So this is the market reality of the last 30 days at the US sector level. The top 4 performers have all been the aggressive growth sectors: consumer discretionary, technology, etc. These are the interest rate sectors, interest rate sensitive sectors. So you would expect, if the news is logically going to lead to further interest rate rises, then you wouldn't expect these sectors to be doing well. And this is the problem that most people have, that at major turning points, the market does things that's just not logical. You look at all the evidence in front of you and you're entitled to conclude that the bear market must continue because things are pretty bad. But that's not how the market works. The market's looking 6, 9, 12 months ahead. And it's looking at a completely different scenario. The fear of inflation stopped being the story of the day a couple of months ago, and the bond market started doing something quite different. And those 4 sectors have made gains of between 5% and 19% in the last 30 days. They're very, very substantial gains in the space of 1 month. Yet most people have just been stuck on the headlines about how bad things are. And just in the last couple of weeks since the US earnings season started, the earnings results from big tech, some have beaten expectations, some have missed expectations by a reasonable amount. But the one thing that is common is that the future guidance has not been too bad, and so that's been a real relief for the market, and those stocks that had probably been oversold have now started to rebound quite nicely. So just for the record, generally all the selling is done once a recession is confirmed, and we're now, depending on what data you look at, we either now have confirmation of 2 consecutive quarters of slowing growth in the US, or it's pretty close. And generally, when you reach that point, the selling's done, and we're certainly seeing that. And I know from the questions and the commentary that I get from different people that a lot are still stuck on the headlines of fear, that it's not logical for the market to be improving when the conditions are getting worse. So if you're waiting for the bad news to leave the stage, then I'm afraid the party is going to be over by the time that happens. Because I think the news will probably continue to be pretty ordinary for a little bit of time yet. So that's the status update. That's where we sit at the moment. Let's turn to American stocks. The S&P was up 0.4% for the week. But in the very short term, the upward momentum is waning, not only at the index level, but also at a lot of individual stock levels as well. So I wouldn't be surprised to see a bit of profit taking in the next couple of weeks. We can't just keep racing up in the manner that has been the case for the last 4 or 5 weeks. But that doesn't change the fact that the overwhelming weight of evidence says that the bear market lows are in, and that we're now back into some sort of rebound. The US dollar was up a bit, 106.5. The 10-year yield got down, I think, to about 2.7, bounced up to 2.8 with the jobs report data on Friday night, but the overall trend in the 10-year yield is now to the downside. The VIX remained, despite a bit of a spike in the futures, a spike down in the US futures with that jobs data. The VIX didn't really move very much. Might have moved from 21 to 22, but then finished back at 21. So the bond market, the the options market really wasn't, terribly concerned about that. And I'm continuing to see a trend of stocks selling off at the open on bad news because, the inexperienced investors are selling into that bad news and then firming during the day. And that's been a fairly distinct pattern over the last few weeks. And then we've also got the 10-year, 2-year spread has now increased to minus 0.41, which is, that's a pretty reasonable negative situation, and is certainly, confirming the fact that the US is either in or close to recessionary conditions. I think we're going to see a surprise from the Fed by the end of the year, and I wouldn't be surprised if we actually see a cut in interest rates before this year is out from the Fed. All right, let's go and take a look at some charts. Just for the record, let's start with the main indices. There's the S&P. We've now reached a medium-term double top. And you can see over the last few days, we're just starting to sort of form a bit of a rounding top. So I wouldn't be surprised to see a bit of a pullback in the S&P. You might see 100 or 150 points come out of the main index. But clearly, we've got higher highs and higher lows. And the shorter term moving averages have now crossed over. The 20-day is now above the 50, and the index value is well above them. So quite clearly, we're in a renewed uptrend. If we look at the Nasdaq, quite definitely, the Nasdaq even stronger, quite definitely higher highs and higher lows, and it is it has advanced very nicely and on pretty robust volumes as well. So the Nasdaq continues to look better than the S&P, and this is one of the other key things that's really taken my attention over the last few weeks, and that's just the breadth of this rally. This is IWM, the Russell 2000, covering a lot of mid and small cap stocks, and this is impressive as well. And we're even seeing money flowing now back into even the more speculative end of the market in Cathie Wood's ARK funds, ETFs. They're all starting to pick up as well. So there's lots of green and promising signs around the US market. Let's get to the important spread charts. This is the Nasdaq versus the S&P. You can see a little tick down on Friday, but very clearly through the week, we had a very strong week last week in terms of the money flows into the more aggressive sectors. And so not much doubt that that's in uptrend. This is the XLY versus XLP, consumer discretionary versus staples. Very, very clear and strong uptrend on the consumer discretionary, albeit it is influenced by Amazon and Tesla to a fair degree, XLY. So I take this chart with a bit of grain of salt because some of the broader retail parts of the US I don't think are doing quite so well. But they're certainly doing better than what recessionary conditions would indicate. This is the Russell 1000 growth versus 1000 value. There's not really much more I can say about that chart. That's incredibly bullish. That's probably the most bullish chart of all. This is mid-cap growth versus the S&P. Very consistent flow of money back into mid-cap growth as well. So again, we're back to the breadth of the market issue. This is large cap growth versus large cap value. So I'm just, looking at all different parts of the market, and it's all just telling the same story, chart after chart. And finally, this is US small cap growth versus small cap value. So there's absolutely no question about the breadth of the rally back into growth stocks. And then when you add to that, and I've been talking about this now for many months, you add back to that the bond market response, the fact that as the Fed are raising interest rates sharply, the bond market is going the other way because it's looking 6 months forward. The options market in March and in May had not reached a level of bearishness that was really consistent with bottoms in the market. And so it turned out they weren't bottoms. But by June, the options market had reached a level that was typical of major bottoms. The media coverage that, you can always bet when there's some major headline on a mainstream publication like, Time magazine or something of that nature that, screams the market's about to crash, then you know that the market crash is already done. So the media coverage had reached an extreme. The level of investor bearishness had reached an extreme that was consistent with market lows. And finally, we were starting to see individual stock responses that were not consistent with the bearish news. In other words, the news was so bad you would expect the share prices to sell off, and they didn't. They turned around and they went up. So all those things are the weight of evidence that I've been talking about. And I hope that this point is really registering with everyone, because, there's still comments coming through that, this has got to still be a bear market for all sorts of various reasons. And, you've just got to try and get past that. If you're a serious investor who wants to do better and repair the damage of the last 6-7 months, then you could try the Portfolio Analyst trial. It's been around, available for a number of years now. It gives you a 14-day look at what I do for $1 to see if if my methods resonate. Or even better, why not just jump straight into the Insiders Club, which is the flagship service. You don't get specific recommendations and you don't get all the service, but in Portfolio Analyst, but you get that in the Insiders Club. I'm making lots of recommendations at the moment. The outlook is very encouraging. So, that's an option if you want more exposure to this sort of market analysis. All right, let's quickly look at the currencies. The US dollar, you can see, is medium to long term. The trend is up, no question. And we've just had a bit of a period of consolidation, but you'd have to say that the direction is still to the upside for the US dollar. And as a result, that's sort of keeping pressure on the Australian dollar, but we've probably done a little bit better than what the US would indicate, because the iron ore price has held up pretty well, and the oil price has come off recently, but is still pretty strong. So that's the current market update. If we just check in on the Australian market, our dollar 68.5 is where it finished. Our index rose 1% across the week, managed to breach the 7,000 point level. But as I say pretty much every week, I don't pay much attention to what the ASX 200 is doing. It's really not a reflection of where I'm investing in the Australian market. Large cap battery materials stocks are bouncing back hard. They were just too oversold, too much negative news, and that always looked like a bit of a no-brainer to me. Precious metals, gold was up by $9 to $1,776, which equates to roughly $2,600 in our currency. Things in favour of gold. The tensions now around China and Taiwan is a biggie, and also the fact that inflation is now looks as though it's well past its peak, and that recession is more the thing that investors are worrying about. And so there are a couple of things in favour of gold being able to continue upwards. Against it, of course, is the US dollar. So as long as the US dollar keeps rising, then that's going to keep pressure on the gold price. So we're still at a situation with gold where I don't see a trend that I can have confidence in the gold market. In the precious metals market, the chart pattern is improving, but again, it's still not anything that really gets me excited. There is some improving momentum locally. So some of the Australian gold producers and gold developers are starting to look better. And definitely in the gold market, you need to be influenced not by the fundamentals and the news, but by what the charts are actually saying. So let's take a quick look at the gold market. All right, this is gold on a weekly chart. So we formed this triple bottom down here, just under $1,700. We're in the process of a bit of a bounce at the moment, but look, really since August of 2020 when we formed that peak, so that's now 2 years, we've been bouncing in this range from 1680 to 2080, so a $400 range over 2 years. And I think you'd be a very brave person to say that the gold is either going up or down. It's really just stuck in this range. If we look on a daily basis, just had a little bit of a peak outside the top of this this declining trend line. Bit of a peak on Thursday, but fell back on Friday. So not much definitive that you can say about that. If we look at silver, we certainly had a very robust week the week before, but there wasn't any follow through last week. And if we look at the actual global gold stocks, this is GDXJ, which does include stocks like Northern Star, for instance, and Evolution Mining. So it is starting to improve. There's a little bit of improvement there, but it's nothing that I would get terribly excited about. Okay, that's precious metals. Commodities, copper, edged up a cent or two, but to all intents and purposes was pretty steady. Nickel edged up a bit, also almost back to $10. The base metals gained despite the fact that there was a higher US dollar. And that's really because they'd just been sold down too hard. There was just, the fear of recession and the fear about demand from China if their property sector was allowed to implode, it just went too far. Crude oil was lower. Again, wasn't that long ago. Crude was at 120. We're now down under 90. And that's certainly keeping the pressure on the oil stocks. And we're back to a $12 to $15 range again. So it's pretty volatile, the oil sector. The reason for the oil price coming off, apart from the fact that there's always going to be a reversion to the mean factor here, and around the 120, 125 mark, all the headlines came out that said oil is going to $200. And as soon as those headlines came out, that was the end for oil. So once again, the media got it exactly wrong at the peak. We're now seeing OPEC indicating that they may increase or will increase output, and that has certainly dragged the crude oil price back down again. There's the spot copper chart, so quite a nice rebound off those 320 lows in July. Nickel didn't fall as far, so hasn't rebounded as sharply as yet. So wrapping things up, this is what I said last week, and I think it bears repeating. You just got to keep investing really simple. You just need to get clear about what you want, the process that you're going to use. And I know that's difficult and challenging for a lot of people, but you've just got to get to that point. You need an environment to minimise the distraction. Too many people are being influenced by the headlines. You've just got to get back to the basics of what is a good investment plan. There are several absolutely wealth transforming themes that are already in train and looking out over the next 5 years. So there's no question about opportunity. And if you're wringing your hands about China or Russia or recession or whatever, then you're just worried about things that you can't control. Most things we can control in the stock market, so focus on them. And then you just need the confidence to stay the journey. And if you're not involved closely enough in the market, then you need to align yourself with someone who is, so that you can gain that confidence to stay the journey, because the next 5 years to me is as exciting as I've ever seen in my 35 years in the market. Portfolio analyst last week was taking stock once a month. We took stock of what happened in July, the analyses that I did, questions from members, things that they wanted clarity around. It's a specific skills development forum. So if you're looking for that sort of input, then Portfolio Analyst provides that in spades. That's it for this week. There's more information on the website. There's my email address, and thank you for indulging me in a bit of a look back over the last 7 or 8 months. But I really think that if you take on board the message about using weight of evidence rather than just a few isolated indicators or what the media is telling you, then I think you're going to end up being a much better investor. That's it for this week. I'll be back with you next Sunday. Cheers.